Welcome to the First Time Home Buyer Workshop with Julie Marion, and today we're speaking about what is an interest rate, why do you need to know, and what will it cost you if you're unaware. Without understanding this, you might commit to a mortgage at higher rates, increasing costs by tens of thousands of dollars over the life of the loan. And it's a lot of money, so it's worth it if you can save yourself a few $1,000s. You can retire early, go on a nice vacation, or whatever you like to do more of it. Here we are going to be giving you acorns and acorns of knowledge to empower you, first-time home buyer, because let's face it, buying a home involves 5 professions with a maze of certifications, regulations, and standards. You're expected to understand all of this in record time, often with little guidance, to the point you are what I call overwhelmed. We drop these videos in an effort to help you because I want you to really learn what you need to know as a first-time home buyer. And when you are so busy with your life, like you probably are, I want you to be able to listen to and learn one little aspect of information before you embark on this big purchase. Now, it would be better to start this process 6 months before you say the words, "I'm going to buy a house." While buying a house is still a dream, but hands down, everyone's journey is different. And we've got to blow out, disassemble, get rid of, completely destroy, and annihilate first-time home buyer remorse, which is well over 50% annually. It's atrocious. And the reasons why are all over the place. It depends on you and what you're not happy with. As recently as November 2023, homebuyer remorse emphasis on home buyer, which could be a first time, a second time, a vacation house buyer, any type of home buyer, was 92% remorse. In my mind, something's wrong with the system that is set up in this country, but it's too big and too complex to rearrange. So the easiest thing is for you to become empowered and savvy. I'm on a mission to get rid of this problem, and I tell you what, the old saying, if I knew then what I know now, things would be different. I was sort of peripherally involved in the real estate field, and I thought I knew a lot. I was surrounded by a lot of really smart people, 2 PhDers in fact, and let me tell you, I made more than one mistake. I'm here to help you along the way, so what happened to me doesn't happen to you. And honestly, I had it pretty good. I can only imagine how bad it is for people that do not have a banker, appraiser, home inspector, attorney, real estate broker, family members that really do know what they're talking about, not Aunt Sally, who does real estate part-time, and they just don't have the good fortunes that I have had. That is why I'm doing this. I really care about you, first-time home buyer. So let's get to it today. Now, when you're thinking of buying a home or a condo, you're probably just thinking of an interest rate related to your mortgage, but there are many. Therefore, at the base, let's start with the basic that an interest rate is the amount charged by a lender to the borrower for the use of the bank's money, typically expressed as a percentage. When borrowing it, it represents the cost of borrowing money. Or when you are depositing money, it's your return on your investment, or the ROI. Interest rates can be fixed, remaining constant throughout the life of the loan term, or variable, most often called adjustable rates, meaning they fluctuate based on market conditions. Interest rates play a crucial role in various financial transactions, including loans, mortgages, bonds, and savings accounts. Another way to think of this is it's the percentage of profit a bank makes in return for loaning you the money. Interest rates exist all around. We have them associated with credit cards, car loans, student loans, and mortgages. Basically, interest rates are a fundamental component of our modern society. From a broad economic perspective, they influence various aspects of the economy, including consumption, investment, inflation, and monetary policy. In another content piece, I spoke of the Federal Reserve, and here again, I want to reinforce our central bank, the Federal Reserve, uses interest rates as a tool in the monetary policy that the Federal Reserve controls. The Federal Reserve on a regular basis adjusts their interest rates they charge banks for borrowing money from the government. That interest rate is called the federal funds rate. This influence of the federal funds rate can influence the borrowing and the spending behavior of the little guy like you and me. Typically, lowering interest rates can stimulate economic activity by making borrowing less expensive, encouraging businesses to invest and consumers to spend. Conversely, raising interest rates can help control inflation by reducing spending and investment. Lowering and raising interest rates, of course, impacts consumer behavior for big ticket items, in my opinion, because people need gas and eggs and milk, but they don't necessarily need a new car or an international vacation. For your investment decisions, you may consider where you want to put your cash based on the interest rate that is being paid, and the same when borrowing. I know a lot of the younger generation is really traveling a lot, and you will recognize when you go to exchange your dollar for, say, euros, the exchange rate is X. But beyond us, the little guy who's traveling and thinking about our stay at a hotel, higher interest rates in a country can attract foreign capital seeking higher returns, leading to an appreciation of the country's currency. Conversely, lower interest rates may cause capital outflows as investors seek higher returns elsewhere, putting downward pressure on the currency's value. Overall, no matter how you slice this, interest rates are a key mechanism through which monetary policy is implemented, and they play a crucial role in shaping economic activity, investment decisions, and financial markets. And at the end of the day, they impact you too. Okay, so you may be saying, okay, that's great, got it, let's move on. But as I said in the beginning, it's a lot here, folks. So let's deep dive. There are 8 significant rates that influence one another. Yep, come deep dive with me here, and you'll be glad you did. We covered number 1, the federal funds rate. This is the interest rate at which commercial banks borrow and lend their excess reserves to each other overnight. The discount rate is the interest rate at which eligible depository institutions, usually commercial banks, borrow funds directly from the Federal Reserve's discount window on a short-term basis. It is typically set higher than the federal funds rate, and it serves as a safety valve for banks in need of liquidity. Banks by law must maintain a level of liquidity so there isn't a run on the banks, like in the movie It's a Wonderful Life. Yes, it really did happen, a run on the banks. So if banks don't have enough liquidity, the feds offer a place for banks to borrow. However, the feds want banks to borrow from one another first, so the incentive is to charge a lower rate via the discount rate than if they go directly to the feds. The prime rate. The prime rate is the interest rate that commercial banks charge most of their creditworthy customers, typically large corporations. It's often used as a benchmark for other lending rates in the economy. Treasury yields. This refers to the interest rate on the U.S. government debt securities, such as Treasury bills, notes, and bonds. Treasury yields are considered a benchmark for other interest rates in the economy and are closely monitored by investors and policymakers. Mortgage rates. Mortgage rates are the interest rates charged on mortgage loans, which are used to finance the purchase of real estate. Mortgage rates can be influenced by a variety of factors, including changes in the overall interest rate environment, economic conditions, and market forces. Now, I want you to pause here. Just because you hear the Fed is cutting interest rates, it doesn't necessarily mean mortgage rates. You savvy first-time home buyer, you need to watch for this part and not get wrapped up in all the sales and marketing from banks and newspaper headlines and real estate salespeople. Okay, so just monitor this. Number 6 is consumer loan rates. These include interest rates on various types of consumer loans, such as auto loans, personal loans, and credit cards. These rates can be influenced by a change in the overall interest rate environment and individual credit worthiness as well. Savings account rates. These are the interest rates offered by banks and financial institutions on savings accounts and other deposit accounts. Saving account rates are influenced by broader interest rate trends and competition among banks for deposits. The federal funds future rate. This is a mouthful. And this is the market-based indicator of market expectations for future changes in the federal funds rate. It's derived from prices of future contracts traded on the Chicago Mercantile Exchange. The reason why you need to understand these definitions and what they do is the relationship between each of these rates. That's the important part. It gives you an idea of where the economy is heading and what you can expect. And you thought you should just go out and find a house. But the economy gives you all kinds of signals as to where it's heading, and when you nail this, you will see the strength of the economy. I'm not going to redefine all of these again, but let's look at what they do in tandem. When you notice certain interest rates are changing, you are able to understand what's happening in the economy, and this will help you in your negotiation of the mortgage loan and the house price. So, the federal funds rate influences most of the interest rates that I just defined. The discount rate, the prime rate, the Treasury yield, the consumer loan, the mortgage rates, the savings accounts, they all typically follow the trend of the federal funds. And depending upon what you are doing depends upon your perspective. So for example, when someone is saving money in that savings mode, they would want a higher interest rate. But when you're buying a home, you want the interest rate cut. All of this boils down to what us, the little guy, will be offered. So we can buy this house. Understanding the interest rate helps you time your purchase, manage your expectations, and negotiate better terms. Knowing even a little bit about how these rates work and knowing where the economy is heading will help you decide, wow, that's a great rate, I'm going to lock in. Or, no, the economy's not doing so well. Let's see if the Feds cut the rate and spurs on some consumer spending. This makes you a more powerful participant in your home buying journey. You're not just a buyer. You are the CEO of this process. We invite you to join our free mini class entitled Home Buying Chaos Unwrapped. The link is below. The class explains who does what and why. So as soon as you walk into an open house, fill out a form or call a banker. You are in charge. Homework. Yep, you've got it. These interest rates, they change daily. So for homework, get a newspaper. I use the Wall Street Journal, but Barron's, Investors Business Daily will be fine. There is a section typically labeled credit markets, and it delineates all these rates. Look there first so you understand what the true rates are. Then when you do go talk to the bank, you will see the markup. Pretty soon we are going to connect your credit score and the interest rate you will be offered. So there's more to come. And you thought looking for a house might be tough. There is so much to know when buying a house. The good thing is we are here to help, and we cannot wait to meet you. Until next time, from the team at the First Time Home Buyer Workshop with Julie Marion, bye for now.